Bismillahirrahmanirrahim. Our today lecture is related to role of financial management and decision making. So it's the outline of today lecture. We'll be talking about what is financial management, what are the objectives of firm, and financial management functions. So what is financial management? As we have covered in our last lecture, we have explained that we started our concept and discussion from the acquisition of a real asset. So financial management also deals with concerns the acquisition to meet the requirement of acquiring a real asset. We required funds, and funds is called financing. It further deals with the management of assets with some overall goal in the mind. Management of assets, it means here the management of current assets is the more emphasized, which is working capital. These are the major financial decisions which we normally discuss in the financial management. So it concerns about the acquisition of assets, means long-term investment or acquisition of real assets to meet its obligation of long-term investment or acquisition of an asset. We required funds, and funds can be raised from the right side of the balance sheet, which is called financing, and we can name it capital structure. That is a mixture of debt and equity. And furthermore, we normally focus on the how we manage the current assets, which is working capital, while keeping some goals in mind. This is investment decisions. There are three key basic criterias while we are talking about investment. What is the optimal firm size, and what assets should be acquired, which kind of assets you want to go to acquire, and next is the asset should be, which of the assets should be reduced or eliminated from your portfolio. So while we are talking about investment, we must have to keep in mind these three main critical decisions, crucial decisions. What is the firm size, what are the assets should be acquired, and which of the assets can be eliminated or reduced. So this is the financing decisions. Here the financing decisions are determine how the assets will be financed and how the assets are acquired, what will be the funding sources, how the funds can be generated, identify suitable type of financing, and this type can be the debt or equity, or it can be mixture of debt and equity. So these are the financing side. If we are going for equity side, then there is the concept of dividend and what will be the best dividend policy for a particular firm and organization. So how will the funds be acquired, then how the funds can be acquired. These are the major components while we are discussing the financing decision. Asset management, this is working capital. How do we effectively manage the existing assets? The financial management oversees the assets to varied degrees. Current assets management takes priority over the fixed assets, because current assets management, it's daily financial decisions. These are the daily financial decisions which are widely used as compared to management of fixed assets. So this is the component of working capital. And working capital here, how the finance manager, how the firm manage their working capital like cash, inventory, or the current assets which are having age less than 1 year. This is the overall organization chart. Organizing of the financial management functions. At the top there are board of directors, then there is chief executive officer, and there are three branches: vice president operations, then vice president of finance, and vice president of marketing. Our subject is finance. Here we'll be talking about finance domain. And in the finance domain, as we have explained in our last lecture, that there are two major branches. One is accounting side, second one is finance side. And accounting deals with record keeping, data management, and this is controller side. And By utilizing the accounting data, we make the decisions, and decisions in finance language is the decisions are related to finance side, and this is the Trier side. Trier side deals with the major financial decisions, and controller side deals with the accounting perspective, like cost of accounting, cost of management, data processing, general ledgers, government reporting, then preparing the financial statement, preparing the budgets, preparing the forecasts. So the Treasurer side, this side utilize the data from the controller side, and there the major financial decisions are made, like capital budgeting, financing decisions, capital structure, cash management, credit management. These are the parts of working capital, dividend disbursement, financial planning, pension management, insurance risk management, tax planning. These are the main component, main functions under the head of Trier department, and these are the main functions which normally deals with with the data handling. This is the controlling department. So financial management, there are some goals, or overall these questions are attempted to be answered by financial management. The chief financial officer is often the firm's senior financial manager. So there are two parts. One is Trier, which deals with the managerial decisions, like Trier manages the cash, credit, capital expenditures, and financial planning, and the controlling department deals with taxation, cost accounting, data processing. These are the all are the duties of controlling department controller. So I have explained these components in previous slides in detail. So financial management, capital budgeting, what long-term investment or incentives should the company undertake? So then we go for the capital structure. What is capital structure? That is made to meet the to fulfill the requirement of capital budgeting. So what method should be used to pay the assets? Then there is, should we rely on the debt or equity? These are the major financial decisions which fall under the head of financial management decisions. So working capital, how do we handle the firm's day-to-day financial decisions or finances to meet its different obligations, like transactions motives, transformational motives, or precautionary motives. These are the motives of working capital management. Here we have discussed in detail capital budgeting. We started our concepts from the long-term investment. Long-term investment is capital budgeting. So what long-term investment or initiatives should the company undertake? Then capital structure, then working capital management. These are the major financial management decisions. So we move forward. Financial management primary responsibility, capital budgeting, the process of planning and managing firm's long-term investment, means long-term investment to acquire the fixed assets or real assets. Fixed assets, capital structure, that's a mixture of debt and equity by the firm. So mixture of debt and equity and capital structure requirement can be met. Capital structure can be raised from short-term liabilities and long-term debt and equity side. So to meet the requirement of long-term investment or capital budgeting, we require funds, and funds can be raised from capital structure side. What is capital structure? That is mixture of debt and equity, or funds can be raised from short-term liabilities, long-term debt, or equity side. So working capital management informs short-term assets and liability, that is called the working capital management, and the difference between current assets and current liability, that is called net working capital. And net working capital is the widely used while making the decision. These are the frequently decisions which are made in the firm, because they deal with the daily financial decisions as compared to the financial decisions of investment or capital structure decision. The working capital management decision is frequently used in the firm. So capital binding decision, that is about fixed assets, tangible asset and intangible asset. These are the fixed assets. What long-term investment should the firm choose, and to meet meet the obligations or requirement of acquisition of long-term fixed assets, we require funds, and funds can be raised from equity side, debt side, or current liabilities. So this is current assets, and the current assets are the working capital of the firm. What is the goal of firm? Maximization of the shareholder wealth. Value creation occurs when we maximize the shares price for the current shareholder. So value is not directly determined. So value is based on the price. So the objective is value maximization of wealth maximization of shareholder. So how the wealth can be maximized is the price of share is high, then obviously the value will be maximized. Then if value is maximized, then wealth will of the shareholder will be more. So we can say that price is a determinant. Price is used to calculate the value of share, value of firm. So shortcoming alternatives perspective, profit maximization, earning after tax. So this is earning after tax. We start from sales, then cost of goods sold is excluded. If we look at the net income statement or income statement, it starts from the sales revenues, then cost of goods sold are excluded, are deducted. Then we have the EBIT, earning before interest and tax. Later interest is also deducted. Later we will be having EBT, earning before tax. After tax, then the profit will there will be profit. What is the problem? After deduction of tax, that will be net income, and net income, it ignores the changes in the risk level of the firm. So this is the problem related to shortcoming of alternative perspective. So then the other one is earning per share maximization, maximizing the earnings after tax divided by the outstanding outstanding shares. So earning per share, how we can determine the earning per share or EPS. So the net income divided after tax divided by the shares outstanding, then we calculate the EPS. And the problems related with this perspective is it does not specify the timing or duration of the expected return. It ignores the changes in the risk level after the firm, and there can be calls for zero payout dividend policy. How zero payout dividend policy? What is the purpose? Earnings per share maximization. If the net income is high, and net income is divided into two parts. One, it can be retained earning, or it can be dividend. Net income is distributed either in retained earning or dividend. If they wanna go for the earning per share maximization, then there will be no dividend payout, zero payout. Then the overall will be net income will be divided by total shares outstanding. Then earning per share will be high. These are the problems related to this perspective. So strengths of shareholder wealth maximization takes account of current and future profits and earning per share, the timing, duration, and risk of profit and earning per share, dividend policy, and all other relevant factors. Thus, the share price serves as an indicator of business performance. Share price, as I have explained, that value is not directly determined. It can be calculated based on the price of share, and share price is a indicator of business performance. If share price is high, then we can say that is the value of firm is more. Now we can talk about the types of businesses. There are three types of businesses where these concepts prevails. So one is sole proprietorship, partnership, and corporation. Now we talk about the sole proprietorship, partnership, and corporations, their advantages, their disadvantages, then how they are different to each other. The sole proprietorship advantages, it's easiest to start. The least, if it's easiest to start, it means there are least regulations. Then the single owner keeps all profits. The tax once as a personal income, because it's sole proprietorship, there will be single tax as a personal income tax will be imposed, not corporate tax, like there is a double taxation, one on the corporate, second one on the dividend as a personal income. So it's easiest to start, least regulations are there. So overall, all the profit will go to the single owner, and tax once as a taxed once as a personal income. There are some disadvantages of sole proprietorship. Limited to the life of owner, its life is limited with the life of owner, and equity capital is limited, owner's personal wealth, because fundraising will be limited, because it's the overall funds can be raised from the owner's wealth. Then there will be less opportunity to invest in the long-term assets, because they are having the limited equity capital. Unlimited liability means overall the liability of overall business is the liability of that person. Unlimited liability. So the sole proprietorship has the unlimited liability. It's the overall business liability. So it's unlimited. Difficult to sell the ownership. Its ownership is hard to sell. These are the drawbacks of sole proprietorship. Then we move forward to partnership. There are advantages, disadvantages. Two or more owners are there. Obviously, they are more than one. Then the more capital will be available for investment. Relatively easy to start, and there will be also less rules and regulation. Income tax is also applied as a personal income. So there are some disadvantages. Disadvantages: unlimited liability, because the overall liability of the business is the liability of partnership. So the partnership is dissolved if one of the partner dies or wishes to sell. Its transfer of ownership is difficult in this form of the business. Now we move towards corporations. Corporations, there are advantages and different advantages. It's limited liability, because the overall liability of the owner is not only the owner's liability, it's the business liability, and its life is unlimited. And separation of ownership and management, here in corporation, ownership and management is separated, and owners are called principal, and management, they are the agents, and owners hire the managers or agents, and agents work for the principals or owners. So their goals should be aligned, their overall interest should be aligned. If there is difference between their interests, then there will be conflict, and then there might be agency problem, agency cost, agency theory will be there. So transfer of ownership is easy. How transfer of ownership is easy? If it's a corporation, then it can raise funds from debt side or equity side. If funds are raised from the equity side, then obviously shares of the firm will be distributed among the shareholder. And what is the distribution of shares? That is the distribution of funds. That is distribution of ownership. So ownership transfer is easy as compared to partnership and sole proprietorship. Easier to raise capital, and capital, they can raise capital from either debt side or equity side. Then they can raise whatever they want. They can raise the funds as per their best interest. Disadvantages: the major disadvantage is the separation between ownership and management, and it creates agency conflict, and there is agency theory, and there will be agency cost. I will explain these parts in detail in later slides. There is double taxation is imposed there. What is double taxation? Income tax at a corporate level. It's the tax. Income tax is imposed as a corporate level, and the dividend then dividend taxed at a personal level. Double tax. So there are double tax taxation is there. One on income, second one on dividend. Dividend is the personal shareholder profit. The tax which is imposed on the dividend will be the personal rate. The tax which is imposed on the overall income of the corporation, that will be income tax. Corporate rate will be implied in corporations. These are the disadvantages. One is separation, and double taxation is there in the corporations. So possible goals for financial management. One is survival. Then survival is important. After survival, once you survive in the market, then the firm needs to beat the competition in the market, then maximizing the sales, maximizing the net income, maximizing the market share, minimizing the cost, maximizing value of stock or share. So these are the major goals of financial management: to survive in the market, to beat the competition in the market, maximize sales. If sales is maximized, then income will be, net income will be more, and obviously that net income is more, then the market price per share will be high. Then cost, to minimize the cost, how the cost can be minimized, to minimize the conflict between managers and principals, and there are other factors to minimize the cost. Then maximize the values per share, and how the value of share can be maximized. If market price per share is high, then the value will be maximum. If value is maximum, that is the wealth maximization of the shareholder. That was the overall goal of the appropriate goal of financial management is maximize the shares is the right goal. Fundamental or economic value of the stock. How the fundamental and economic value of the share can be determined. Why shareholders own shares. Managers as agent should act in a way to benefit the shareholders. It means the managers must have to work as per the best interest of principals or owners, because managers are hired by the owners or shareholders, and they have to work in the best interest, or their goals should be aligned, their approach should be aligned. If they are aligned, then they will work in the best interest of shareholders. So benefit shareholder, that is enhance the value of shares, and value of shares is not directly measured. It based on the price of share. A limitation of this goals is that value is not directly observable, but it can be observed through price. If the price of share is high, then the value will be more, then value will be maximized. Obviously, that is the wealth maximization of shareholder. So value versus price, the value of share are not observable. In contrast, the price of share is observable. If one believes that share price is an accurate or good estimate, and it's the price, the price or valuation is properly done, then it's not overvalued or undervalued. Its price is calculated on fair basis by different models. So obviously, if the price is accurate or good estimate of the share value, then the appropriate goal would be maximize the price of share. Yes, because price is observable. If the price is accurate or good, then we can say the value can be observed. So value of share is observed by the price of share, as I have explained in detail in our previous slides. So in modern corporations, there are two parties. One is shareholder, second one is management. There exists a separation between owners and managers. Shareholders, they are the owners. Managers, this is the management, they are the agents. In modern corporations, they are separate to each other, and if they are separate, the role of management, the management role is the management act as an agent for the owners of the firm. So managers are hired by the owners. Who are the owners? They are shareholders. They are shareholders, and agent needs to work in the best interest of owners. In the best interest of owners. So role of manager is the agent is to work to value maximization, wealth maximization. So they have to work for the best interest of owner. An agent is an individual which is authorized by owner, another person, by another person. Who is another person? He or she is an owner. They are called principals. They are called principal to act in the latter behalf. So agent works on the behalf of principals. Principals, who are the principal? They are owners. So they have to work in the best interest of owners or principals. So agent is an individual which is authorized by owner or principal, which is authorized by owner and principal to make the major financial decisions. So here is agency theory. Jensen and Mackling 1976 developed a theory which is based the form that deals with the behavior, of manager based on the agency theory. Agency theory is a branch of economics relating to the behavior of principals and their agents. So it deals with behavior, conflict between principals and agents, that is of behavior. If their behavior are aligned, their goals are aligned, means agents need to work for the best interest of principal because they are hired by the principal. Agents are hired by the principal. So the agency theory deals with the behavior of what? Behavior of principals and agents. So management must provide the incentives to management or agents. Then they will be motivated. If providing the incentives, they will work in the best interest of principals. Management acts in the principal best interest and monitor the results. Then principal needs to monitor the results, either their performance, based on their performance, their decisions which are made after providing them the incentives, how either they are enhancing the value of firm or not. Then incentives, these incentives can be in form of stock options, they can be bonuses, stock options. If the principal provide them the stock option, it means they give the incentives in form of stocks. If they provide them stocks, then the management, they are owning the stocks. If they own the stocks, then they will be obviously the owners of the firm. If they will be having the ownership, if they are having the ownership, obviously they will make the best decisions. They will work with their best interest, and they can also they can be provided the bonuses. Then the management will be more satisfied. If they are motivated, satisfied, if they are compensated, then they will work with the best interest of principals or owners. So agency relationship, if we look at the agency problem and agency relationship, with what is agency relationship? Principals, stockholders hire agents, means management to run the company. What agency problem? If there is a conflict between the managers and stockholders, means principal and agent, that conflict is called agency problem. Conflict of interest between principals and agent, that is called agency problem. This occurs in corporate setting where the agents do not hold the firm's share. It means agents are not having the ownership. If they are provided the stock option, then they will be having the ownership. If they are having the ownership, then they will work for the best interest of the principal. Then there will be less conflict. If there is less conflict, then there will be less, their decisions will be more rational, their decision will be efficient, the value will be enhanced. The sources of agency problem is the separation of ownership and management. Owners are the control and management is the agent. The separation, because they both are separate to each other, that's why there are the chance there arise the conflict, agency problem between management and ownerships or owners. Agency cost, there are two costs related to this concept. There are two costs. One is direct cost, second one is indirect cost. The direct cost is unnecessary expenses such as monitoring cost. The indirect cost, monitoring cost, while your monitors your agents or management, keeping an eye what they are doing, and either they are working in the best interest of management or not, that is direct cost. So agency cost, there are two types of cost. One is direct cost, second one is indirect cost. Indirect cost, that is related to managerial decisions, strategic decisions. If the manager is not taking the efficient decisions, rational decisions, best interest decisions for the management, obviously the firm will lose the opportunities where they can make the good profit. For example, manager may choose not to take on the optimal investment. So how they can, if they are not having the best interest, if they are not working at the best interest of owner, obviously there is indirect cost. If manager is not making a rational decision of investment, optimal decision of investment, obviously they are losing the opportunity. If they are losing the opportunity, then that is the cost which is bear by the firm and which is bear by the owners of the firm. And for she or he may prefer less risky. It means here we have discussed the types of manager: aggressive manager, hedge manager, or risk avoider, conservative manager. If the manager is conservative, obviously he or she will not take the risk. If they take the less risk to protect their position, to keep their position in the organization, then they don't go for the risky investment. If they don't take the risk, obviously there will be less return. Profit will be low. If profit is low, the value will be minimized as compared to maximized. It means the the owners are bearing the indirect cost. So in this sense, there are two types of cost: direct cost, which relates with the monitoring. This is direct cost. Direct, how to monitor their activities, then the owners have to bear some cost. Indirect cost, this is related to the decisions of agents or financial managers. If they lose any opportunity, obviously that opportunity will bring a significant loss in the profit or revenues of the firm. So managing the managers or corporate governance, yes, this is important. How we can manage the managers, that is how we can manage the managers by providing them the compensation. There is a concept of managerial compensation. Incentivize the managers. Incentives can be used to align the management and stockholder interest. If the management provide the incentives in form of stocks or in form of bonuses, then their interest can be aligned. If their interests are aligned, obviously then the managers are being to be managed. That is called corporate governance. The incentives need to be structured carefully to make sure that they achieve their goal. What is the goal? The profit maximization, profit or wealth maximization of shareholders. If their interests are aligned, what are the interest between stockholders and management? Stockholders and management, they should be aligned. If they are aligned, there will be less conflict. If there is less conflict, then there will be no urgency problem. If there is no urgency problem, then there will be no cost. If there is less cost, no cost, then the profit will be high and value will be maximized. So the incentives need to be structured carefully to make sure that the key objectives, key goals are achieved. While making the incentives can be the stock options that are either can be bonuses, which are given to the agents or management by the owners to bring their interest with the interest of owners. So corporate control, the threat, there should be also threat from the management, from the ownership or principals of a takeover may result in the better management. So control, corporate control, there should be also corporate control to better management. If there is threat to take over, to take over, then they can be then manager can be or agent. The threat, there should be threat of takeover. They can be throughout from the firm. If they are having the threat, their position is not stable in the firm, then obviously they will work in the best interest of the principal. Ethics, this is very important. Very important. Managers are expected to behave ethically. Behave in ethical manners. If they behave ethically, obviously they will work for the best interest of owners. They will work in the best interest of owners, because owners, they are hired by the owners, and if they are then they will make the rational decisions. He or she must ensure to sort out what is good and what is bad for the firm. If he or she behaves ethically, having the ethical manners, obviously then the manager or agent will work for the best interest of owners, and their interest will be aligned. Then there is a social responsibility. There are different school of thoughts: social responsibility, corporate social responsibility. Literature states that a few of them called it a cost for a firm, and few of the proprietors or scholars state that it's the investment for the firm. Yes, the firm wealth maximization does not rule out the firm from being socially responsible. If the firm contributes in the society or welfare of the society, obviously the firm will be having good word of mouth. Then it will attract the shareholders, investors, and investor will invest in that firms, and they will be having the shares. If they invest in the firm, then the price of share can be better. If price is more, then the value will be high, maximized, then there will be the value maximization. Wealth maximization does not rule out the firm from being socially responsible. Assume we view the firms as producing both private and social goods, then shareholders' wealth maximization remains the appropriate goal in governing the firm. So as I stated, that few of them take it cost and few take them investment, because if the firm is involved in the welfare of society, it's taking the social responsibility activities, initiative in the social responsibility activities, then obviously it will be having good word of mouth, and good word of mouth will attract the investors. Then they will invest in that firm, and the funds will be more available for firm, and their price can be rise, market price